session on 5 major changes in international taxation introduced in the Union Budget 2017. I am Chandan Goyal, founder and CEO of Blue Consulting Private Limited, which is an expert in managing tax compliances at pan-India level. We are a strong team of 110 people, and in the last 12 years, we have worked with more than 100 reputed and professionally managed companies in India. So in today's session, we are going to discuss in detail about the 5 major changes in international taxation provisions, which you should be aware about. So let me give you a list of these 5 changes which we are going to discuss. So the number 1 change is introduction of secondary adjustment in transfer pricing has been introduced. The second major changes in international taxation is the interest expenditure has been restricted to 30% of EBITDA in certain cases. The third major change is the period of concessional rate of TDS has been increased in case of foreign borrowings. And the fourth and fifth change is related to foreign tax credit. The fourth one is restriction on carry forward of excess foreign tax credit under MAT provisions. And the fifth one is adjustment in assessment order is possible if the dispute related to foreign tax credit gets settled. So let's start with the number 1 and the major change, which is introduction of secondary adjustment in transfer pricing. So before giving you a detail about the provision which has been introduced, let me give you a little brief or little history about the secondary adjustment, why it was introduced or what is the reason for introduction. In the recent case of PMP Auto Components, the Mumbai ITAT has ruled in favor of assessee that secondary adjustment is not possible as per the existing transfer pricing regulations which are prevailing as of now in India. So this secondary adjustment concept is not new, it is well there in the other countries which have adopted the transfer pricing mechanisms. So what exactly is secondary adjustment? So secondary adjustment is carried in respect of the primary adjustment, where the primary adjustment has resulted in increase of income in the hands of assessee or decrease in the loss in the heads of assessee. So let us understand the concept of secondary adjustment with the help of an example. There are 2 companies, we are taking this example in an Indian context. So the Indian company name is ABC Limited, and it is having an associate enterprise named XYZ Inc. in USA. So ABC Limited is providing services to its associated enterprise, and for a particular year the amount of this service or for which the service income has been accounted for in ABC Limited is 100 crore. During the transfer pricing assessment, the TPO assess this 100 crore income based on the arm length price at 120 CR. So the 20 CR is increased, and this 20 CR is accepted by the assessee. So now what happens, this 20 CR is considered a primary adjustment, and which has resulted in additional income in the hands of assessee. So as per the current provision, there are no regulations for repatriation of this 20 CR from XYZ Inc. to ABC Limited, because as per the arm length price or the adjustment, this 20 CR is undue benefit which is going to be or which has already happened to XYZ Inc. Now as per the secondary adjustment, why the secondary adjustment is carried out. So secondary adjustment, the principle is that this 20 CR which is accruing to the associated enterprise as a benefit should come back to India, and if it doesn't come back to India, it should be considered as a advance given to associated enterprise which is XYZ Inc. and a notional interest will be calculated on this 20 CR and it will be added back to the income of ABC Limited. So this is the secondary adjustment, and the secondary adjustment is only possible when either the adjustment made by assessee himself or it has been made by TPO and accepted by the assessee. So basically there are 5 situations. So let me brief them one by one. One, that if the primary adjustment is on account of the suo motu adjustment made by the ABC Limited in its books of account while filing the tax return. Second, if the adjustment has been made by the TPO and it is accepted by the ABC Limited. Third situation, when it is as per the safe harbor rules. The fifth one is if it is determined as per the APA advanced pricing mechanism. The fifth one is if it is as per the mutual agreement procedure defined in DTAA. So there are the 5 situations where this primary adjustment is possible. And one more thing is that this secondary adjustment can only be carried out if the primary adjustment is more than 1 CR, then only it can be carried out. So this is the secondary adjustment provision. The second important change which has been introduced in Union Budget 2017 related to international taxation is a restriction of interest expense up to 30% of EBITDA. So let me give you a little brief about this concept. As we all of us are aware in international taxation that OECD has taken a very important project named BEPS, Base Erosion and Profit Shifting, wherein in the action plan 4 it has come out, or it has discussed about this concept of base erosion and profit shifting due to excess interest expense allowable or claimed by the multinational enterprises or entities. So considering the recommendation given in action plan 4, a new section has been introduced in this union budget named 94B, which restricts the interest expense payable to an associated enterprise, a non-resident associated enterprise, up to a minimum of the following: 30% of the interest which is calculated, interest which is 30% up to EBITDA, earning before interest, tax, depreciation and amortization, or actual interest, whichever is minimum. And this again, just like secondary adjustment, it is only applicable if the interest expense paid or payable is exceeding the limit of 1 CR. Second condition is that this restriction is not applicable on a banking or an insurance company. So how this will happen? So for example, in a particular year, the interest payable by the Indian company to its associated non-resident entity is 10 CR, and the 30% limit on EBITDA comes to 8 CR. So the Indian company will get the deduction of interest only up to 8 CR, not 10 CR. So this additional 2 CR, which was not claimed in the current in that particular financial year or assessment year, will be carried forward or can be carried forward for 8 assessment years starting from the assessment year where it got disallowed. And in the next assessment year also, this 30% cap will also be applicable. And this provision is also applicable on the implicit or explicit guarantee given by the non-resident AE for the loan taken by the Indian entity, and it is also applicable if the associated enterprise has kept some equivalent to that debt to a non-AE entity outside India. So this brings us to the third change which has been introduced in the union budget related to international taxation. The third one is the concessional rate of TDS applicable on foreign borrowing excuse me, has been increased. So as per the current provision of section 194 LC, there is a 5-year window has been specified for the loan agreement which was entered for a foreign borrowing from 1st July 2012 to 1st July 2017, and also for the long-term bonds issued within a window of 1st October 2014 till 1st July of 2017. So now this window has been extended by 3 more years. So any loan agreement entered or any long-term bond issued before 1st July 2020, the concessional rate of 5% will be applicable. And further, this section has also made it applicable on the low rupee denominated long-term bonds. So now we come to the fourth change, which talks about the restriction on the carry forward of the excess foreign tax credit under MAT provisions. So if you are aware, if you remember the rule 128 and the sub rule 7 in that rule, it already talks about that foreign tax credit or the foreign tax paid is available as an adjustment regarding the MAT liability, and it talks about that the excess foreign tax credit after the adjustment against the MAT liability of the current year will be ignored or it will not be carried forward. However, there was no such provision in the section 115JAA and 115JD, which is for AMT, just like MAT, which is applicable in case of LLPs. So now the section 115JAA and JD has been changed, which says that excess foreign tax credit after adjustment of MAT will be ignored and it will not be carried forward. So it is just a clarification. Similarly, the fifth change is also related to a clarification that the assessment order can be adjusted now if there is any ongoing dispute related to foreign tax credit and it got settled. So as per the current provision of sub rule 4 of the main rule 128 related to foreign tax credit, this provision is already there. So now it has been introduced as a subsection 14A under the section 155 that the assessment order can be changed or can be amended if the assessee within 6 months of the settling of the dispute inform to the assessing officer or submit the following information to the assessing officer. Number 1, proof of the payment of the foreign tax, proof of the settlement of the dispute, and the third, a declaration or undertaking that the credit against this foreign tax credit has not been taken elsewhere. So this brings us to the close of this session, and wherein we discussed about the 5 major changes. I hope this session was worth of your time and attention. And if you need any clarification or additional information related to these changes, please feel free to reach out to us at the contact information or the information given below this video. And watch out this space for more such session in near future. Thank you so much.